All right, so separately stated items in a partnership, remember we've got ordinary income, which is essentially all of that income that if it were a sole proprietorship, that would show up on our Schedule C, right? So it's gonna be subject to self-employment tax. But then we've also got these separately stated items. These are items that would, that the partnership income and expense items that would be treated differently on a per partner basis. And if you recall, the K1, so we looked at a K1 when we were in chapter 8, I think it is. We looked at the K1 and we already talked about ordinary items, ordinary income and separately stated items. So essentially, ordinary income, which we talked about in the last section, there is everything up here on box 1. Separately stated items are pretty much everything else. And they are separately stated because they are treated differently for each partner, depending upon other items that are on that partner's tax return. So for example here, we've got, so ordinary business income up here, $60,540. This particular partner, Lulang, received $42,000 of guaranteed payments for services. So this person contributed services to the partnership for which they were reimbursed. They were paid regardless of income. So it wasn't based on income. And remember, in order for it to be considered a guaranteed payment, it has to be, it can't be, oh, it's 10% of whatever our net income is. It has to be a set amount. It could be on an hourly basis as well, or a salaried basis. That's fine. It just cannot be dependent upon the income of the partnership. Those guaranteed payments, remember that amount is deductible, so it's not going to be included in that $60,000 up here. Whoops, they get a deduction for that. But for the individual, this is treated like self-employment income, so it's going to be subject to self-employment tax. So everything that applies to Schedule C, all those tax rules that apply to Schedule C income would apply to those $42,000 as well. But the other partners get the benefit as well of having that now not be included in their ordinary income. So for this partner, it's not up here, but it's down here. It's really kind of in and out for them. It's really not going to make a lot of difference to them, but for the other partners, it gets them a deduction for that amount that they paid to the one partner. In addition, so we've also got dividends here, ordinary dividends, qualified dividends. In this case, $1,100. Remember, those qualified dividends are taxed at either 0%, 15%, or 20%, depending upon other income on our tax return, what our tax rate is on that other income. So for one partner, that tax rate may be 15% for those qualified dividends. For another partner, it might be 0%. We've got to separate that out because it is treated differently per partner. Short-term capital gains, long-term capital gains. Again, when we did all of that netting of capital gains, and remember our capital gains are offset by any capital losses. Well, one partner might have capital losses, whereas another partner doesn't have capital losses. So those gains and losses are going to be treated differently on a per partner basis. That's why we've separated them out and treated them separately. I don't know what that other income is, but all of these items are separately stated. Section 179 deduction as well, recall that is on a per partner basis because we have those limits. Those limits are on a per taxpayer basis. Now, one thing that we haven't talked about yet that is a separately stated item, trying to figure out how they got 91,940. They don't have a 179. I'm gonna have to see what they did there. Because they've got self-employment earnings of 91,940. I'm gonna have to see what they did here. I don't know that that's necessarily right, that amount. Anyway, back up. So one of the things that we haven't talked about yet that we will talk about are this box 19, distributions. This means that this particular partner received $26,000 from the partnership. Now, they also got that $42,000 of guaranteed payments. Remember, that's like self-employment income. They're going to pay, that's for services that they rendered. That's earned income. The $26,000 is a distribution. That means they got cash out that already belonged to them. Maybe they originally, well, it looks like, let's see, if they had put $116,900 into the partnership, then that $26,000 there is just what they're taking out from what they already put in, right? So the $26,000 is not going to have a tax effect on the partner as long as it doesn't bring their ending balance down below zero. Remember, we cannot have a basis below zero. They call it a capital account here. Capital account is a little bit different from basis, but a lot of times it's going to be the same. The amount's going to be the same. This is kind of just that running tally for basis. And when we talk about things that affect basis, that'll become a little bit more clear when I'm talking about this $26,000. That is then, it's not taxed because it's money that's already been taxed. It's part of their investment in that partnership. I need my water. But again, that's a separately stated item because it applies only to that partner in the partnership. It's specific to that partner. So you can kind of think of it that way. All of these items are going to be, they're specific, well, all of it is specific to this partner, but these things are going to, all of these things are going to be treated differently for tax purposes based upon the other items on the partner's tax return. And so thus, they don't go in one place. This is going to go on the Schedule D. This is going to go on the front of the Form 1040 and combine, it might go on the Schedule B as well. It's going to combine with other dividend income. Let's see other things here. This is going to go on the 4797. I don't know what this other income or loss is, that 2600, so I don't know where that would go. Let's see. Oh, so this one, did we go through this before? I don't know. Maybe it's just one from me looking at it. I can't remember. It's been a week and a half, right? Okay, so in this case, we've got an individual whose percentage ownership changed during the year. So for part of the year, they owned a certain percent, and then maybe they invested additional amounts later and changed their investment percentage. So Knox is a partner in Knox, Smith & Wood Partnership. He owned 33.3% from January 1st through March 31st. So for 3 months of the year, he owned a third. When he bought Smith's 33.3% interest, so he bought out another partner. Therefore, as of April 1st, he owned 2/3 of this partnership. Partnership had $76,000 of ordinary income and $8,000 in long-term capital gains. We have to apportion, though, those out over the course of the year, because he owned a third of it. If he had owned a third of it the entire year, then he would have a third of all of these items, but he owned 2/3 of it for part of the year. So the calculation for that is we're going to take $76,000 for the ordinary income times the 3 months of the year, 3/12 of the year that he owned a third, and then take the rest, 76,000 times 9/12 of the year times 2/3. So his ordinary income on his K1 is going to be $44.33. Capital gain, we're going to do the same calculation. So his capital gain that's allocated to him is $46.67. So for Smith, their portion is going to be 33.33% times 3/12, and that's it. right? They didn't own any for the rest of the year. So they're gonna have a third for a fourth of the year. Same thing for the capital gain. Does that make sense? Okay. All right, so self-employment income. Partner, again, is not an employee of the partnership. Yes, go ahead.
Sorry, so that top one, so that ordinary income and the capital gain, that's what would be on this, the K1 that he gets, okay.
So his box one, K1 would be 44,333. And then the capital gain, if it's long-term or short-term, we don't know, that's gonna be in one of these boxes. So
okay.
Yep. Oh, they don't have the, so this is where, but they don't have, they forgot to put the, there's supposed to be a 179 deduction on this in box 12 of 10,600. That's where the calculation is coming from, but they didn't put it on there. That's what's missing on that K1 in the example, okay? All right, so self-employment income. Partner's not an employee of a partnership, therefore all of that income, because it's like a Schedule C, but multiple people own it. So the tax treatment has to be the same as if it were a Schedule C, right? So it's going to be subject to self-employment tax. There are some little differences, like those guaranteed payments, that's a benefit of a partnership as opposed to a Schedule C. You don't get guaranteed payments as an individual owner of a, or as a sole proprietor for any amounts that you pay yourself. You don't get a deduction for that, but for a partnership, you do get a deduction for that. So that's one difference, a couple other little differences, but for the most part, it's like a Schedule C business, but more than one person owns it. Okay, so we have to make sure that the income is treated the same. So self-employment income for a general partner, this should be checked too, general partner, it's not. General partner means somebody who is, they are working in the partnership. They are providing efforts toward the partnership. So it's earned income. If they were a limited partner, if this is checked, then it's an investment. They've just provided money. Their money is what's working, not them. Now, for general partners, it might be both. They may have contributed money and they're working in it. But if it's earned, if they're earning the income, then they're a general partner. That would mean that all amounts in box 1 would be considered self-employment income. All amounts in, I don't know why they have this, oh, for capital, in box 4A and 4C. These are not two separate amounts, by the way. The total amount of guaranteed payments was $42,000. Of that $42,000 was for services that were provided, okay? This is self-employment income as well. Any amount of 179 deduction would be subtracted, would be a reduction in self-employment income, okay? Like I said, this should be 10,600 because what they have up here, 91, I don't even know if that's even right, 91,940, 600, that's not even right. What do they have down here? No, I guess that's right. So 60,540, that's from box 1. 42,000, that's the guaranteed payments. They have an amount here for a 179 deduction, but it's not listed on that K1. 10,600, so their total self-employment income is 91,940, which is the amount that's listed here. That's the amount that would be subject to Social Security and Medicare tax. If this individual has other income, maybe they've got a W-2 job and they earn $150,000, well, guess what? That's only going to be subject to Medicare tax, right? Because they're already over the 147 threshold. They're probably also going to be pushed into the additional Medicare tax if they're single. All right, so this is the calculation for self-employment income. So remember that qualified business income deduction that we got as a sole proprietor? Well, because again, we're just like a sole proprietor, but with more than one person, we still get that qualified business income deduction if we qualify for it. So the same calculation would hold for determining how much that qualified business income deduction is. So 20% of the income minus the 1/2 of, and the calculation, we'd have to subtract out the 1/2 of self-employment taxes. Remember, we had to make that adjustment. But again, it's 20%. So same calculation. So if you're doing a look at chapter 6 to remember what that calculation is. Questions? So these are separately stated items. All right.